Blake.
Good afternoon or morning. Good morning, Dale.
No, we don't know anymore. We have to look at the clock. So great to have you back with us, Blake.
Thank you, sir. It's nice to be on with you, and God bless you.
Thank you.
How you doing?
I'm doing okay, buddy. So the dollar bulls claimed major victories yesterday. I was surprised by the extent of the move in the dollar yesterday. It's tough for me to know what to do in here. I feel like I can't get short and I can't get long. Where are you at in these different markets with the dollar strength that we're having? A lot of highs were confirmed. I have to wait for some resets to go counter trend here.
Well, I agree actually, and here I'll go ahead and I know you like me to do some screen sharing with you, so I'll show you the charts that I'm looking at. Let me move you over here. So that was like one of the big conversation pieces of this morning on our Morning Edge webinar was, the dollar is too strong to be shorted. Right. It's too weak to be. It's too weak to be bought. So you're kind of stuck between a rock and a hard place. And after a big move like we saw yesterday, the bottom line is you're stuck in a situation where you can't really chase the dollar much higher, but at the same time you don't want to fade it. So you have to take a look at the dollar and where it's at and what could possibly happen. And that led me to believe that it was going to be more of a consolidation, maybe slight pullback of the dollar. I've got some bids to buy the dollar, like if the euro gets to 130. I might try to pick that off today, but I'm hoping like most people that and I have some dollar long exposure against commodity currencies,
and
but
they've been relatively commendable considering the strength of the dollar, how the Aussie has held up.
Yeah, and a lot of that has to do with risk appetite. Obviously stocks have been going higher. We're sitting just a few ticks away from all-time highs. So as long as the stock market stays elevated, I don't see any reason why the commodity currencies are going to come under too much pressure. So unfortunately, my profits have been very limited because I took a lot of my profits off the table as the dollar has been surging, off the euro. Right. Taking my shorts off the market a little early, of course, because as a trader you try to get the meat of the move. You never try to time the actual bottom or the top. Well, you try. A lot of people try, but the majority of the money is made as you're scooping up the the meat of that trade. So I've missed the last tail end of this dollar move with the euro and the cable and whatnot.
That's a pretty interesting triangle we're looking at, approaching resistance.
Yeah, and so there's a couple things about the dollar. I mean, Mohammed El-Arian of PIMCO, he pointed this out a week ago, that the volatility in the FX market is likely to increase because the increasing demand for dollars from multinationals, which and he made a good point stating that multinationals, they'll hedge, but they're not market timers. They just, if the trend is going, they have to hedge their exposure. Right. If they're getting paid in euros and and the euro is going down, they're going to have to hedge and get long dollars to hedge that the dollar rally versus the payments that are coming in. There's a lot of different ways multinationals are going to do that. But the bottom line is, if the dollar really starts to take off, the acceleration could really continue. And I think most institutions, central banks, whatever, that are looking at the dollar right now, they're all on the cusp of probably getting ready to take some pretty big positions. Now, I would also argue that the dollar is pretty overbought. I mean, if you look from a relative strength basis, we're near levels that you see only when we peak. Right. So right now would be a good time to take some dollar long exposure off the table, I think. And then I thought that since yesterday, since we did the double bottom. Right. Extension, and we hit it perfectly, by the way, yesterday.
So that was a measured move at the high yesterday.
It was a perfect measured move. I mean, it was perfect. I tweeted about it yesterday and whatnot. Now the question is, how far is the dollar going to come down, and how do you want to play that dollar weakness? Because I think that the dollar is finished for the next week or two or a couple of weeks. We're going to consolidate, so we're probably not going to rally against European currencies too much. It's interesting to see what's going to happen with the with the Scottish independence vote, which, you know, most people will say there's no freaking way. You talk to anybody out in Europe, they're going to tell you there's no way Scotland's going to, go independent. But the vote is a little scary for cable longs, and I think that's going to keep the pound under pressure. And, you know, maybe the polls will switch over the weekend, and the pound will bounce back. Who knows? But I think against the euro, Swiss, Swedish currencies, you take a look at, like, I'll take you over to the U.S. dollar Swedish krona, which has been I've been trading it to the long side for the last several months. Wow. You know, this is a weekly chart, so you can see why I've been trading it to the long side. But we've hit channel resistance, 786 retracement. I don't want to chase it long anymore. I think it can pull back. So I think these European currencies are going to pull back here, or at least consolidate. And the dollar's obviously showing a bit of a reversal against the yen. So the dollar yen, could quite possibly pull back too. I do think that the dollar, though, could firm against commodity currencies if we indeed see the U.S. equity markets show some weakness here.
Yeah, I need a close under 1990 as a 2-week candle reversal. 1990.
Yeah, I think that's what everybody's looking at, and since everybody's looking at it, you think so? I know for let me double things. Okay, so here's the Nasdaq. The Nasdaq had a bearish engulfing pattern Wednesday, and so yesterday, I was like, hey guys, I know the Nasdaq's up 15 points right now, but we're probably going to close down today. And everyone, no.
Couldn't even recover the day before losses.
Yeah, we ended up closing down, and so now we're getting that follow through. If the S&P closes below 1990, let's say you're correct, and the S&P closes below there, especially on the futures, we are going to see a bit of a reversal. And we got, you look at the Dow, the Dow is multiple stabs at highs, failed breakout attempt yesterday at all-time highs, so we're sitting on a lot of support. And if those support levels give, dollar yen breaks below 104.70, you're probably going to see some near-term weakness. Now, and that is what would have me skeptical about being long the Canadian currency, the Aussie currency, and the Kiwi currency. Okay. And then also to mention, Dale,
I'm in your Aussie yen trade. I put it on yesterday. I thought I had a third drive to a top, but it was a little early. But I'm still sitting in it.
I'm still sitting in it too. It's some fib confluences up there. I'm a big. You give me 161% extension, coupled with a 618, and I can show you that chart here in a minute. I'll take that trade any day of the week, and I'll let it float a little bit. It's just because it's such exaggerated Fibonacci levels that are more playing to the human psyche than anything. So that's why I play them. Now, crude oil. This is an interesting chart. We've had this big consolidation here, and if crude breaks down because the dollar is strengthening, again, you look at the Canadian. You don't want to be long the Canadian if crude oil is falling. You look at gold. Gold is threatening, even today. Yeah, it's threatening. Really key support. We
have the same target, so I'm looking for about 1,200.
Yeah, I mean that would set up a nice Gartley. Yeah. And again, I drew this just kind of list what if, but the dollar's strengthening, so dollar strengthening, gold's probably going to come down. You look at these commodities, they are buckling under the pressure of the U.S. dollar. So again, if you're trying to play the Aussie to the long side, and then I'll go to the Aussie yen. Here's the Aussie dollar. We're in this really.
There is usually a pretty good correlation of Aussie and gold, and but Ed Matz uses gold and Aussie, but says that gold leads it by about a week and a half, 2 weeks.
Well, there you go. I mean, if that fractal plays out, and I have
nice divergence at
utmost respect, highs, as you know, I have
nice divergence at today's.
Yeah, good hourly divergence. So again, being long the commodity currencies up here doesn't make a whole lot of sense to me. You have the Aussie dollar that's just kind of creeping higher, but we start running into this 94-cent level, it's going to have a lot of problems. So that takes me over to the Aussie yen, which again, it's 618 retracement of this fall. Okay, so you got the 618 retracement of the fall. You got 161% extension of the summer's move, and you're I know you can overshoot fib level, so that doesn't really worry me that we're above it by 20 or 30 pips, and even shot above it a little bit. This area, this area is going to provide resistance, and I always try to tell traders, especially newer traders, support and resistance, or fib levels, or resistance, horizontal channel, whatever you're looking at. It's not an exact science. If it was an exact science, my life and your life would be a whole hell of a lot easier. It's all an approximation. So these zones, if you see a fib confluence like you see here, it's a zone. It's a zone that's going to provide, resistance or support for a currency.
And our trades in those zones should provide tolerance for it not being an exact science.
Exactly, and that's a great point that I think you and I and instructors of the market and instructors of traders really have to accentuate the fact that you have to give your trade some breathing room, especially when you have currencies. You trade currencies, you trade with such massive leverage that, well, hopefully you don't. You trade with the ability of having such massive leverage is that you tone down your leverage size so you can give your trade some breathing room, give your P&L a little bit of breathing room, so currencies can whip back and forth like they do up and down 30, 40, 50 pips and not affect your bottom line, affect your P&L to where you're making rash and poor decisions. So it's such a key component of trading the FX market, in my opinion.
What's your take on the bonds here? We left an island top, Blake, and TLT, and I was early on I did some put buying in TLT before the blow off to yields at 3% on the 10-year, but we left an island top there, and the bonds look vulnerable to me. A lot of people are saying, well, if the S&Ps break down, money will flow into bonds. But at the beginning of the year, I thought the bond rally was going to imply weakness in the S&Ps, and they both went up together. Why can't they both go down together, bonds and equities?
Well, they probably could. And I'm not a bond person. I mean, obviously, I like to follow bonds because I'm trading the yen. Right. So naturally, if I'm short the dollar.
Yeah, you would think that the bonds
I expect the dollar yen to go down. I do want.
Yeah, you would think the bonds would rally if we're right about the yen coming off.
Exactly. So if I'm going to short all the yen pairs, which I'm thinking about, especially seeing this reversal in the dollar yen, I'm going to be rooting for bonds to go up. Now, but that would be against like every professional bond trader that I truly respect. Everybody out there is saying the bond market's coming down, and
yeah, Tepper jumped on that bandwagon yesterday, and
he did. He jumped on that bandwagon. You talked to like Kevin Ferry of Cronus Futures. The guy's he's a market genius.
Right.
Probably one of the smartest guys I know in the markets. I'm understanding, as I'm understanding him correctly, he's probably a little bearish on bonds too, at least in the near term. But you talk to every bond trader out there, most of them are going to tell you that yields are going up.
I'm looking at 2 3/4, and then one more massive bond rally to under 2% on the 10-year.
Well, here's the
4.6 after that.
Well, Dale, let's think about the market pushing. Nostra Pinkert. Well, the market is going to try to push in what direction it thinks the Fed is going, and if the Fed is, if they think that the Fed's the trajectory is going higher, then bonds should come down, rates should go higher. But there's a lot of people, myself included, I would be in this boat, that are very skeptical of the Fed ever being able to start a program or a regiment or a cycle, of raising rates.
Yeah.
I sent out a chart of what the Fed funds look like versus.
Does the market do it without the Fed?
Well, it'll try. I think the market will try to price that. I firmly believe that. But I guess the question is, if the Fed even attempts to raise rates, how is the market going to, how's the real economy going to take that, and how's the stock market going to take that as a result? And those are questions that we won't have answers for another year. But if I look at Japan, or I even look at the European Central Bank before the European financial crisis did the same thing, trying to bump up rates from these ultra low levels, or Bank of Japan over the years when they tried to bump up rates and had to eventually reverse them. I have a feeling that the Fed's going to be doing a lot of false starts with trying to raise rates in the future. You know, they're going to. I mean, this will be a perfect attempt going into next year, and but I guess we're talking more near term. I guess that would mean that, you know, bonds would probably come down in the near term as people price in a more
just so you know, just on a technical basis, Blake, TLT is the bonds have fallen from what 3% to 230. So why not back to 260, 270 before the next bull move in bonds?
Right. So you're thinking something like this.
Yeah.
Well, then what I would do if I was trading bonds, then what I would simply do is just keep an eye on this channel.
Okay.
And trade in it, not against it. So you know if you're on the short side right now, that's fine. You happen to be mid range right now, but you get on the long side down here, and if it breaks below, then your Nostradamus skills will probably come in.
About 113.5 on TLT.
Yeah, about, I would say by the time we get there, maybe about 114 and change, 114.10, somewhere in that neighborhood. Yeah, no problem. But that's how, you know, just eyeballing it, and not, again, I'm the wrong person to be talking to about bonds and rates.
Yeah. Really, well, I mean, if you measure the highs going back to over that 130 level to the low of 101, I think we approached or just took out or went. Look at that, 61.8, Blake.
Yeah, big fib level. So that was obviously a rejection. That doesn't mean it's going to hold. But
islands, no man is an island.
Yeah, there are some.
So there's some people stuck.
Oh yeah, they're stuck on the island. Out. They're doing the Tom Hanks action. Yeah. So.
All right. So the flow I'm getting from you is, the European currencies. They've been bashed. They've been in a car wreck. They're in shock. Probably not much more to the downside. Should be at least a bear market rally, and the vulnerability, especially if the S&Ps start breaking under 1990, is going to happen in the Aussie commodity currencies.
Yeah, and one other point I wanted to make with you and your wonderful trading group that you have here is that the dollar has been pretty strongly correlated to equity markets, but really for only one reason. The equity markets only go up. So, if you go, well, the equity markets have just gone higher, so the dollar's been going up with equities. It has been in lockstep. But we haven't seen much downside to provoke any type of real fear in the markets either. So with it, let's say like today, and maybe over the course of the next week, we pull back in the equity markets a little bit. We break below 1990, and you go, oh, hey, here comes a little bit of a pullback. Might have a 1%, 2%, 3% pullback in equities. If that's the case, you might see some dollar weakness as a result, just because the correlation has been so positively correlated to equities. Okay. There is a trade out there, and people may, have forgotten, because traders tend to have this, ADHD type of mentality, and you tend to forget, or short-term memory loss, whatever you want to call it, that when the market is fearful, they tend to buy dollars. They tend to be risk averse, and they look for safety. So they say, well, crap, I need to own dollars now. I don't want anything else. Just give me dollars. That trade probably won't come into fruition. It won't really start to bear fruit unless you have when the market's convinced. And no one I know is convinced, and maybe you know some people, that the market's turned. I mean, it's going to need more than a 50-point down day in the Dow for me to be convinced that, hey, we have made a definite turn in the markets. Once the market is convinced that there is a intermediate top placed in the equity markets, I
think that'll be
globally,
around the 1930, 1940 range, more than a 4% pullback, which is what we've had consistently. All the pullbacks have been limited to 4%. So, 4% would be right around there, the 1950 range or so.
I would say that's probably a pretty good guesstimate, somewhere in that neighborhood. Yeah. Once you see the market, and market participants look a little fearful, like the the deer in headlights look. You start getting equity market longs that are stuck long. They start getting fearful. You start seeing that fear trade come in. That's when the dollar is going to benefit.
Okay.
Reap the rewards of being the reserve currency. So I'm looking at it as if the stock market does, and this is the E-mini futures. So if we correct a little bit and we start pulling back, after this 127% extension that we hit perfectly, by the way, if you guys can't see that, we hit 127% extension. If we roll over and we start breaking back below, you're going to get some people going, all right, well, the stock market's coming in. I need to sell some dollars, But it's really once you start getting below the, like you say, 1930, maybe 1920, you start breaking below some of these supports, and that's when that fear trade comes into play. That's when people go, oh my God, I need dollars right now. I don't want anything else but dollars. So. But that's the way I'm looking at it right now.
I'd like to pose a question to you that I'm posing to people. Can you think of one thing that could change the structure of this bull market in the dollar?
Bull market in the dollar could change the structure?
Shifted from not just being bounces in euro and pound, but to a reversal of trend. Can you think of anything that would make that happen? Because I can't.
It would be the only way, in my opinion, is there's two ways. The Fed. So we start getting commentary from the Fed about that. About
they relent on the taper.
Really. Yeah, or they really downplay the possibility of us, raising rates in the first or second quarter of next year. If the goalposts start to get moved back towards the third quarter or fourth quarter of next year, because they're starting to look at the economy as wobbly. Like let's say the jobs picture continues to no, it wasn't. And if deflationary pressures don't let up, so let's say wages continue to be stagnant and incomes and spendings stagnant, that continues to happen, the Fed may become less hawkish. And if that happens, then you have to trade on interest rate expectations that the dollar might indeed slow down. But as far as right now goes, I think everybody's understanding that the U.S. economy is on pretty good footing, and the European economy is a little wobbly, and we have divergent central banks. We've got the Fed going one way, ECB going the other way, and that's going to play into the dollar for what it's worth.
Another month, maybe, huh?
Yeah, and you take a look at the U.S. dollar Japanese yen that's already showing some weakness. Hey, listen, the BOJ met this week. They didn't give any indication that they were going to do any type of easing. So if you're wondering why the U.S. dollar Japanese yen isn't blowing out of its socks and breaking that 16-year trend line, that's probably it. I mean, the BOJ didn't give us any indication that they were going to continue to ease despite the slowdown in consumption from the tax.
There's not a bear left because today's highs took out last year's high.
Yeah, and that's right. And they did it in Asian trade, which is those sneaky little suckers. Yeah, they did it right in Asia.
It was like a Pearl Harbor.
It was.
All right.
Dang it.
Blake, I tell you what, I always enjoy talking to you, and I love your tweets, and I recommend people spend some time in Morning Edge, and you have a lot of fans in our community, a lot of people that are grateful for the work that you do to edify them and give them ideas and analysis, and I'm glad to know you, buddy.
Same here, Dale, and thank you very much. And I know there's a lot of traders out there that know, what you're dealing with personally. I know, but I'm for those people that maybe are just tuning in and are people that follow me on Twitter and like, oh yeah, I listened to Blake's webinar. I didn't know this was even around.
Okay. Well,
guys, Dale does a lot to help the community. So make sure you follow Dale, help him best you can.
Thank you, Blake. I've discovered being in this battle that people have just not had enough of me yet, so I plan on sticking around, buddy.
Well, we plan on having you around, so thank you, Dale.
All right, buddy. Have a great weekend. Good hunting, Blake.
You do. Same
Thank
to you,
for
sir.
the
Thank you,
Aussie
everyone.
yen call.
All right. Bye-bye.
See ya.